So welcome to this session of my tutorial on IAS 33, earnings per share. This is the second video on the standard. In this video, I want to examine the treatment of bonus issues and right issues in the calculation of earnings per share. So what is bonus issue? Remember in the part 1, I've told you that private issue will be divided into two. One is the bonus issue, and the second one is the right issue. Bonus issue can also be called capitalization issue or scrip issue. It's an issue of new shares to an existing shareholders in proportion to their existing shareholding for no consideration. An issue of new shares to the existing shareholders in proportion to their shareholding for no consideration. It means if they want to issue a new shares, that new shares will be issued to the existing shareholders. The issue will be made to the existing shareholders in proportion to the shares they already have, and they will not pay any consideration for it. No money will be paid for this issue. This means that in bonus issue, no cash is involved. In other words, new shares are issued free of charge to the existing shareholders. New issues or issues are made free of charge to the existing shareholders. The new issues or the new shares are created by converting the reserves or share premium into a new shares. So if they want to make a bonus issue, I've told you no cash is involved. What the entity will do is to convert part of their reserves to shares to the existing shareholders. That is to tell you that the bonus issue are usually made to the existing shareholders in proportion to the shares they already have in that company. And I mean, what I'm trying to say is that if Mr. A is having 2 million shares and Mr. B is having 5 million shares and C is having 3 million shares, that means the total shares they are having is 10 million. So if they want to make a bonus issue of 500,000, so Mr. A will receive 2/10 times 500,000. So this will give us 100,000. Mr. B will receive 5/10 times 500,000. It means this man will receive 250,000 shares. And this person will receive 3 million over 10 million shares times 500,000. This person will receive 150,000 shares. It means the bonus issue will be made to the existing shareholders in proportion to their shareholdings. I've told you that in the bonus issues that no cash is involved. That means the issues are made free of charge to the existing shareholders. So I've told you the new shares are created by converting the reserves. What the entity will do is to debit the share premium or any other form of reserves, or to debit the equity reserves. So they should debit reserves and now credit the share capital. So that is the double entries required here. So they will debit the reserves, thereby reducing their reserves. Then they will now increase the shareholding of the shareholders. So that is the double entry for the bonus issues. What are the steps for solving bonus issue? What are the steps? We want to examine the steps. The first thing is to calculate the bonus fraction. Step 1. So we are looking at the steps for solving bonus issue. Number 1, calculate the bonus fraction. The bonus fraction. Suppose the entity want to issue 1 for 3. It means the person who is serving the existing shareholders here, since it is existing shareholding, 3. If you have 3 shares, they will give you extra shares, bonus share of 1. That is the meaning of 1 for 3. So the total now will be 4. So the bonus fraction now, bonus fraction will be 4 over the existing shareholders. So over the existing shareholdings. So this will be the full bonus fraction. The first step is to calculate the bonus fraction. The second step is to calculate the weighted, step 2. Calculate the weighted average number of shares. Weighted average number of shares issued by multiplying the shares, the existing shares, by multiplying the existing shares before the bonus issue by the bonus fraction. Calculate the weighted average number of shares issued. I've told you it is this weighted average number of shares issued that will be used to calculate the earning per share. So to do that, you have to by issued by multiplying the existing shares before the bonus issue by the bonus fraction. So now I've given you the table. I said we have date or period, the table for calculating the weighted number of shares issued. We have date or period, then we have number of shares issued. Then the second one we have cumulative number of shares. Then this cumulative number of shares you multiply by time fraction. Then the existing one too, for the existing shares, you multiply by the bonus fraction. And that will give you weighted average number of shares issued. So this is the table that will be used. So the difference between this and the earlier one, where issues are made at the market value, the difference is to multiply the existing shares by the bonus fraction. I've explained how to calculate the bonus fraction in step 1. Step number 3, calculate the basic EPS. The third step is to calculate the basic EPS. Step 3, calculate the basic earning per share. And the step 4 is to calculate the comparative earning per shares. Calculate the comparative EPS. To calculate the comparative EPS, the EPS for the base year EPS multiplied by reciprocal of bonus fraction. Reciprocal of bonus fraction. Reciprocal means 1 over the bonus fraction. Suppose the bonus fraction is 4 over 3, so the reciprocal of it becomes 3 over 4. What you have in the denominator, if you have 1 over this, the numerator comes to the denominator, while the denominator goes back to the numerator. So that is the steps you need to follow when calculating the EPS involving bonus issue. Example, an entity had 1 million shares in issue on 1st of January 20XY. They issued 200,000 shares at market value on 1st April, followed by a 1-for-5 bonus issue on 1st August, with a further 300,000 issued at market value on October 1st. If profit for the year ending 31 December 20X1 is $220,000, what is the basic earnings per share? This question is obtained from Kaplan, ACCA study test. Now, let's have the solution to the question. Solution. So I've told you the starting point is to calculate the bonus fraction, working one. We want to calculate the bonus fraction. What is the bonus issues given? They issue 200,000 shares at market value on 1st of April, followed by a 1-for-5 bonus issue. 1-for-5. That is to tell you that the existing shareholding will be 5. The bonus issue will be extra 1 share. Therefore, the total shares after bonus issue becomes 6. Therefore, bonus fraction will be 6/5. That is working number 1. Working 2 is to calculate the weighted number of shares, weighted average number of shares issued. So, the first column is the date or period. After the date or period, the next thing that follow is number of shares issued. Number of shares issued. After number of shares issued, we have cumulative number of shares. After cumulative number of shares, we have time factor. So we have the bonus fraction. Now, you were told an entity had 1 million shares in issue on 1st of January 20X1. The year in question is year 20X1. So on the 1st of January, the shares the entity had is 1 million shares. 1 million. Then they issue 200,000 shares at market value on April 1st. April 1st, they issued 200,000 shares. 200,000 shares was issued. That means the cumulative number of shares become 1.2 million. 1 million plus 200,000, which is 1.2 million shares. Then after the 1st of April, followed by a 1-for-5 bonus issue on August 1st. August 1st. A bonus issue, 1-for-5 bonus issued. 1-for-5 of 1.2 million. 1.2 million. Please note, 1/5 of what we have here of cumulative number of shares, which is 1.2 million. 1.2 million divided by 5, that gives you 240,000. The bonus issue is 240,000. The cumulative becomes 1,440,000. If you add 240,000 to 1.2 million, it gives you 1,440,000 shares. That is bonus issue on August. With a further 300,000 issued at market price on October 1st. Then October 1st, they also issue another 300,000 shares. 300,000. The cumulative number of shares become 1,740,000 shares. That is the cumulative. Then the time factor. This was in the system from January. If you count from January before the next one was issued, the next issue is April. That means we have January to March 31st. March 31st, before the next one was issued. The last day before the very day the next one was issued, which is March 31st. If you count from January to March, January, February, March, that is 3 months. That means the time factor to use in multiplying that will be 3/12. The next one was issued on April 1st. Then the next one is August. April to July 31st, before the day the next was issued. From April 1st to July 31st, April, May, June, July, that is 4 months. So you multiply this by 4/12. Then after the next one was issued in August 1st, the next issue is October. That means we have from August 1st to September 30. If you count from August before to September, August, September, that is 2 months. So that means we use 2 months to multiply this. 2/12. Then the next one was issued on October 1st. October to the end of the year. The accounting year end is ending 31st December. So it's December. That means we have from October 1st to December 31st. And that is October, November, December, which is 3 months times 3/12. Now, this is bonus issue. I've told you that you have to multiply the shares in existence before the bonus issue before the bonus issue were made. Those shares the entity is serving before the bonus issue were made, you have to multiply it by the bonus fraction, which is 6/5. No, this is bonus. The bonus issue were made here. Then this and this were in existence. So bonus fraction. So since this is bonus issue, it is from here we have bonus issue. It means these shares and these shares were in existence before the bonus issue. So you multiply that by bonus fraction, 6/5 being the bonus fraction, times 6/5. Then from bonus issue to the last one, you don't need to multiply by the bonus fraction. Now, 1 million times 3 divided by 12 times 6 divided by 5. That gives us 300,000 shares. This is 300,000 shares. This is weighted average number of shares in EU. Then 1.2 million times 4/12, 4 divided by 12, times 6 divided by 5. That is for 80,000 shares. 1,440,000 times 2 divided by 12. That gives us 240,000. No, this is where we have the bonus issue. I've told you you should not multiply that place by the bonus fraction. It is the shares already held before the bonus issue were made that you will multiply by the bonus fraction. Please bear that in mind. Now, 1,740,000 times 3 divided by 12. That gives us 435,000 shares. 435,000 shares. If you now sum up all these, plus 240,000, plus 480,000, plus 300,000, we have 1,455,000. 1,455,000. This is the weighted number of shares in ICAG. Weighted number of shares in ICAG. Now that we've gotten the weighted number of shares in ICAG, we can now calculate the EPS. So to calculate the earning per shares, EPS, we say is equals to earnings, which is profit. You were told if profit for the year ending 31st December 2021 is 220,000, which is the profit 220,000 over the weighted number of shares in EU, which is 1,455,000 shares. 1,455,000 shares. So we have 220,000 divided by 1,455,000. That gives us $0.151 per share. This is the solution to the question. You are not to reinstate the EPS. You are not given the EPS for the comparative period. So if it were given, you will have reinstated the EPS for the comparative year, that is 20x. Now this EPS computed is for 20x1, then the one for 20x0 will be the comparative. Now multiply by the reciprocal bonus fraction, which is 5/6. We use 5/6 to multiply the EPS for 20x0 in order to get the comparative EPS. But since the EPS for 20x0 is not given, there is no need for us to calculate the EPS for the comparative period. I will stop this video here. In my next video, I will examine the right issues in the EPS computation. Please drop the love emoji and also like the video. Thanks for watching ZICA.